Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We have a really awesome show today. Our guest is Fran Kinniry, Principal Head of Vanguard Investment Advisory Research Center. Fran's been at Vanguard, since 1997. Has been the global head of private investments, global head of portfolio construction. We're going to talk with Fran about the role of advisors, set up for investors today, Vanguard's entrance and updates to private equity, much more. Fran, welcome to the show.
Thanks so much, Meb.
I love talking about Vanguard. Vanguard, the late Jack, one of my favorite, most quotable people in the world, like the Mount Rushmore of investors and educators. And I feel like when I talk about Vanguard, though, you go back to its origin story, what is that, 30, 50 years now? What percentage of listeners do you think would know that Vanguard has its origins as a actively managed shop?
I would probably put it at under 5%. Our brand has become synonymous with indexing and potentially even index on the equity side. But we actually, as you point out, Meb, we were started as an actively managed firm. And we are one of the largest actively managed firms in the world and also one of the largest fixed income managers in the world.
I always love my little odd stats. And one of my favorites that listeners have heard over the years that certainly by assets, most of y'all's funds are passive. But the last time I looked, by number, you actually had more active funds than passive. And I feel like anytime you say that, people's minds just explode. I don't know if that's still the case, but it was the last time I looked it up.
It's probably pretty close. And again, close to $2 trillion in active management. And so that would put us as one of the largest active managers in the world.
You started at Vanguard in 1997. Talk to me a little bit about 2024. Any big picture thoughts? I know you guys are a kind of own the haystack sort of idea, but late 90s, I was graduating college, and man, that was a fun time. Stocks were going to the moon. Everybody was interested. CNBC was on everywhere, and I feel a little bit of that today. Like you don't see CNBC on at every restaurant anymore, but maybe you see people checking their TikTok on their phone. What do you think? What's the similarities? What's the differences here 20 plus years later?
Yeah, I would say some of the similarities you pointed out there, Meb. At the late 90s, the internet and technology was really just taking hold. And so there was 5 years in a row with 20% plus returns on the equity market from 95 to 2000. Here, I think it's a little bit different. We did have a bear market in 2022. It seems like it's been a long time ago, but that's only 2 years ago where stocks and bonds were down. So we didn't have that same concentration of a 5-year bull market. Yes, we've been in a 10-year bull market. Equities have been very, very impressive. But it's only 2 years ago where both stocks and bonds were down, and down pretty significantly, and one of the worst years annually for the 60-40 portfolio. So I would say the things that remain the same is discipline, investor behavior, broadly diversified portfolios, low costs. Those things are pretty enduring.
You guys have, in one of your pieces recently, and we'll put this in the show notes, listeners, a chart where this chart to me is complicated. And it's complicated because I want as many people as possible to be invested in the stock market. I want 100% participation. And I want people to understand what's going on and be a part of this amazing engine, this concept you mentioned, stay the course. But there's one chart that it always makes me a little bit nervous. And it was in one of y'all's pieces that mentions the percent of U.S. stock allocations to equities.
Yeah, that's one of our more favorite charts that we have out there. And it does show exactly what you're saying, Meb, that through most of history, investors were momentum investors. They would buy after a 3-year, 5-year return. And you see, really, it's just an asset allocation chart of stocks, bonds, and money markets. And you see that momentum or lack of rebalancing behavior throughout time, where equities go up, equities peak, they come down in the bottom of 2002, they run up in front of the global financial crisis and come back down in 2009. But the great thing is what we see is the last 10 years, if you look at the chart of the last 10 years, it looks entirely different from the prior 30 years. And again, I'll say that there's been two bear markets there. You had the COVID bear market, and you had 2022, which was just 2 years ago, with some really extreme bull markets of equities in between. And you see it pretty flat lined at that. It's like 60, 20, 20, 60 stocks, 20 bonds, 20 money markets. And that's been, plus or minus a few percent over the last decade. And you would ask yourself, how could that possibly happen when you've had so much volatility and such a raging bull market? The conclusion is cash flows now are not momentum, they're contrarian. We're seeing tremendous cash flow in the last 1 and 3 years to fixed income, which would be almost incredible to see 20 years ago. And we're seeing that. So equities are up. I was looking at a chart today. I just couldn't even believe it. Like the 3-year return on stocks and 5-year returns on stocks are like 13 and 20%, with bonds being negative, but you have positive cash flow in the bonds. So to us, that is great discipline, great behavior. It's kind of tied to our theme of advisors alpha, of advisors moving to a policy, a benchmark, and rebalancing to that. And so we're actually thinking that the investment landscape for the average investor is going to be much better served than it was 20 years ago, where it was a lot more chasing of returns.
Yeah, one would hope. There's one of my favorite Bogle videos from YouTube we'll throw in the show notes where he was talking about the late 90s period and the importance of rebalancing. That's the discipline of consistently trimming when times get a little nutty. But on the flip side too, as you mentioned, like bonds, you have a bond allocation when it was at 0, it gets absolutely whacked. And then now you got magical 5%. I feel like the boomers, this is like you won the passive income lottery now. All of a sudden they got a 5% yield. But it's funny as you talk to people, because a top 5 chart of the year to me, and this is actually, it came out last year, but I didn't see it. It was in, I believe, The Economist, and we will post this in the show notes, but it's Vanguard data where you guys post the retail investors' median equity allocation by tenure of the account, meaning when was the account opened and then how much do people have in stocks. And so the really interesting takeaway is that everyone's experience is different. And if you were started investing like me in the late 90s, you got that bug, you had probably had an E-Trade account, you were probably trading CMGI, you ended up having a lot more median equities than someone who started in the global financial crisis or in the depths of 2022 or 1982. It's almost like everyone's experienced a different reality.
Outside of the movement to indexing and the movement to low cost, I would say the other real positive tailwind is this behavior. So I don't disagree with you that people have different experiences, and a lot of it is tied to when their initial event happened. But not only are you seeing advisors lead with a policy portfolio and rebalance it to it, think about all of the retail investors that were once unbundled in a 401k plan, which is basically you start your day of work, you get your benefit brochure, you have an open supermarket of what to invest in. And what we saw back then is clients either put all their money in cash or all their money in their company stock. Along come these things known as target retirement funds, and you own the whole world in a market cap way, in a very low cost way that stays rebalanced, that starts at 90-10 and de-risks through time as you age out and near retirement. So we're just seeing the benefits of the capital markets really accruing to the end investor, unlike any time in the history. A different way to say that is the leakage that was there for the average investor in the capital markets in the 70s, 80s, 90s, and maybe even early 2000s was pretty stark. And the leakage now has really been lowered to where investors are getting the majority of the returns. And so for us, that's a great thing. And that's probably a lot to do with the Vanguard effect.
There's a great reference you had, which I'll have to explain to the younger listeners. You said advisors have the choice to be Blockbuster or Netflix. What do you mean by that?
When we entered with the Advisors Alpha, the value proposition was really about hire me as an advisor and I'll try to outperform. We all know the research and statistics on the case for indexing. And then if you add 1% of an advisor fee, it's just a value proposition that's probably not going to last or endure. And so I think a financial advisor business is not immune to technology and innovation and disruption. And we've seen a tremendous transformation happen within the advice industry. Think about how much was transactional based 20 to 25 years ago versus fee based. When I look at the average expense ratios 25 years ago when we started Advisors Alpha, the average expense ratio, I'm looking at it now on funds, was 96 basis points. It's down under 40 basis points today. So just an incredible amount of progress. The blockbuster Netflix is you had to actually go drive and get your videotape in a store that had one movie of each thing there. And along comes the internet and technology and innovation. And we have billions of choices that we can select from being Netflix. And so I just think those who have been on the end of trying to fight technology and innovation have always lost out. And so I'm actually very glad the advisors we partner with, because that's my role, I partner very closely with the advisor community, have been very quick to embrace technology, innovation, and a new value proposition, which we call Advisors Alpha.
We got a piece, which I think is a lot of fun to read. This one's a couple years old, but you guys kind of update these quarterly. The evolution of Advisors Alpha, people with portfolios. And you guys talk about this, you put numbers to some of this behavior and ways that advisors can help. And on an after-tax basis, you can say this is like, could be 3 percentage points, not 3 bips or 30 bips, but 3 percentage points. You want to talk about kind of the different parts of that and how they work together to create a flywheel?
We broke it into different modules, and some of them are larger than others. So asset allocation, so how you get to an asset allocation of hypothetically 60-40 versus 40-60, obviously that matters. So working with a professional who knows how to do that. Fund selection is a big part of it. If you select a fund that is underperforming or has high cost versus low cost, again, the advisor can do that. It's a very professional service. A lot of leakage is in taxes, so after tax returns, so things like asset location, tax efficient rebalancing, tax efficient retirement income withdrawal. We've shown to generate income in a tax efficient way could easily add 1% to a portfolio. Behavioral coaching is another one your audience may be familiar with, Dalbar or the Morningstar Behavioral Gap. Vanguard and my team have created the behavioral gap that we track for the last 20 years, and it's on average about 150 basis points. And simply that's just looking at when the cash flow comes in versus when the cash flow comes out. So if investors now are all plowing into mega cap, large cap growth stocks, they may not have had the returns of the last 10 years. And so it's really thinking about how do you stay the course and eliminate that leakage of behavioral drag, tax drag, cost drag, and then collectively our work has shown that that adds up to, if not exceeding, 300 basis points. There are some funds out there, which I don't want to name them, but they're very well-known funds with some acronyms that most people would know. And the drag is close to 25 percentage points, meaning that the time-weighted return is 7. That's the return of the fund. But when investors bought and sold, have a negative 19% IRR, and that's the return that the investor had.
That's not good, Fran. Negative 19. That's probably the reality of some of the Instagram ads I get claiming they're going to do 50% per year. We say so much in our investing world. I feel like people spend 90% of the time talking about, hey, like, what's a good investment? Are stocks expensive? What do we think about gold at all-time highs? What's the Fed going to do? What about this election? And on and on. And like this boring basics of fees and taxes are so simple, and yet so many people do these just own goals. We love these like Morningstar yearly. They'll do a, hey, here's some of the worst offenders of mutual funds that are paying out giant capital gains distributions this year of like 20, 30, 40, 50 plus %. And it just floors me. I mean, I get why people may have held them 20 years ago. I get why people that are maybe still stuck in some of them because of the cap gains exposure, whatever. But looking at this list and thinking about people still buying them today and the amount and billions and billions and billions of dollars still in these funds is crazy. But the good news is you guys have the leading chart in your paper on people with portfolios, which is cumulative net cash flow into funds based on cost as one example. And that is a one-way street, it seems like. It's like an alligator jaw.
What has happened is the industry has professionalized. And what I mean by that is, as you mentioned, Meb, there are areas that are very much in control of what we do as professionals. Eliminate cost leakage, tax leakage, behavioral leakage. Those things are very much in the control of either the individual investor or the advisor, and they add so much value. The things that are not in our control tend to get all of the glamour and what's gold going to do, what Bitcoin going to do, what's going to happen with the Mag 8 or Mag 7. We're in forecast season, right? Everyone's going to come out with their 2025 forecasts, and not to pick on the forecasters, but we know just how poorly forecasting is done. And so we just try to tune out the noise, figure out the asset allocation that is best for you, stay the course, and eliminate all of these leakages that are there. And investors will really be well served.
Do you have any advice to advisors on how they can stay relevant?
I think the best way to stay relevant would be to play what I would call these positive sum games. We all know the capital markets are zero sum game, right? If I want to buy Apple, I have to buy it from someone who's selling Apple. And collectively, we both can't win. Those are called zero sum games after friction. But there's a lot of positive sum games out there. A lot of them involve what we've been talking about is eliminating the leakage there. And then also concentrating on the service model, being just great with the relationship and the service, because most investors are not. Investing is emotional. It has a lot of volatility to it. It has a lot of news cycle to it as well. And so I think that most clients would be willing to pay the 1% advisory fee to eliminate all the leakages of costs, having the right asset allocation, asset location. How do you get me a check in retirement? Year-end tax planning and gifting. How do you gift to charity with low basis stock? Potentially direct indexing is something also that's coming that Vanguard is entering pretty big there, which we can actually harvest more losses to make the portfolio more tax efficient. These will all require the advisor helping clients there. And so for all that, we think there will still be a bull market for advice, and technology and AI will enable them to be more efficient and to do the things that clients actually want. Clients want great service, and they want to eliminate a lot of these leakages. They don't want to be told a story that I know what's going to happen in the future to growth or value or small cap or emerging, when we know that the hit rate on that is very poor.
A couple years ago, you guys made an announcement where you said, you know what, we're thinking about private equity. And I feel like a lot of people say, wait, what? Vanguard? This is like Costco offering, I don't know, McLaren's or something. I'm trying to think of the right analogy. Like, this just seems like something that maybe would surprise people. Talk to us about that evolution. You guys kind of rolled this out. Walk us forward. How's it going? What are the updates? Tell us about the original inspiration and where we are today.
Yeah, I think it did surprise some investors. It kind of links to your first question, Meb, of how many people would know that Vanguard started out active, and it was probably a handful. The way I would describe Vanguard is actually an innovation company that is really at its core trying to democratize or retailize, bring to the average person, the average retail client, sophisticated institutional portfolio solutions that have worked, but it may have been reserved for the ultra pension market or ultra high net worth. And a lot of people may not know this, but Jack Bogle, who I had a great relationship with and was friends with and was able to have lunch with him almost monthly up until his passing, he did not start the first index fund. A lot of people think that he did. Indexing was around in a separately managed account for about a decade at a very, very large pension mandate only. What Jack did is he brought the index fund to the masses, to the average school teacher, the average nurse, the average UPS driver. And so we took an institutional separately managed index account, and made it retail with a $3,000 minimum investment. We've done the same thing then with traditional active on the equity side, traditional active on the fixed income side, both taxable and municipal. So our entry into private equity follows that same thing. Endowments and foundations and private investors have been using private equity for a very, very long time. But the average investor couldn't go out and necessarily get access to the world-class managers, negotiate terms for the average client. And so this follows really our history of taking sophisticated investment solutions that may have been reserved for the largest mandates and bringing down market to the average American investor. And so I was part of that launch. I led the launch for Vanguard into private equity. And so we are doing quite well. We're up to about $2 billion. And it's not Vanguard doing well. Our clients now can participate in private equity in the Vanguard way, which is with a great manager. We hired HarborVest, very known manager with high access and really good trailing performance. And then what we do is, instead of it being one client negotiating, we bring our 50 million investors and we get terms that are similar to a large pension or a sovereign wealth fund. And so that's what we do. On behalf of our investors, we bring them world-class solutions, we find managers, we get them access, and then we negotiate fees for them that they can't get on their own. And it's worked out really well, starting 50 years ago with the first retail index fund. Private equity now, as we mentioned. We're doing the same with direct indexing as a recent launch in the last couple of years. And we're going to continue to innovate as we move forward. That's just been in our DNA. It's just innovation and taking world-class solutions to the average investor.
So how does someone okay, I'm interested in the Vanguard private equity. How do they access it? Is this something you can just buy through a traditional mutual interval fund? Is it a private offering? Do you got to go through an advisor? What do you do?
So it is direct through Vanguard. Again, we've only been in this business for a little bit. We started with a qualified offer. And so a qualified offer would be for clients that meet the certain qualifications. And they are usually for good reasons. The regulatory environment wants to make sure that the client is sophisticated enough. So they either have enough assets or some investment sophistication test to get it. But that was our entry. And we are continuing to work on our initial offer to see how we can, again, continue to bring that down market. We don't have anything to report right now, but we're working very hard to take the qualified offer and bring that down market. And eventually, at some point in time, the hope would be even more access for Vanguard investors in private investments.
And these end investors, is this the traditional 2 and 20 model, or what is the kind of fees and costs on this type of offering?
Yeah, the fees are not going to be like an index fund, so it's not going to be sub 10 basis points. What I would say is the fees are very fair relative to how private assets are charged. But instead of getting it at, let's say, a client who may put $1 million in, you're getting it as if you were a large, one of the top pension funds or one of the top endowments, because we've been able to negotiate. When an asset manager sees Vanguard and 50 million investors, they will treat us and $9 trillion, they don't see us as each ticket being $1 million. They see what the potential, they see $2 billion coming in 2 years since we've had the offering.
And then when people hear private, in my mind, they hear illiquid. How do they get out? Is this something they got to hold for 10, 20 years? What's the exit sort of opportunity?
It is. It's an illiquid private offering, a private equity. So first, we think it adds diversification because none of these companies are in the public equity market. And for some of your audience might know about companies staying private for longer. And some of the small caps, they come into the market now, mid cap, large cap, right? Because of this phenomenon. If capital is there in the private markets. So it actually is giving our clients exposure to a part of the equity market that they don't have now, which is the private equity market. It is illiquid. You will be in the investment for probably 12 to 15 years until you get your last dollar out. That's clear, your last dollar out. If you put in $1 million, hypothetically, you should have at least your initial purchase of that $1 million back in 4 to 7 years. But then it does have a long tail to it that your very last dollar will come out 15 years. We do advise most clients how they use private investments is they do a vintage fund, meaning that you may do $1 million in 24, $1 million in 25, $1 million in 26, almost like a laddered bond portfolio. You want to make sure you're investing because you're getting capital back as well. And so to maintain your allocation, it is really a continuous cycle of getting cash flow back and putting new cash flow in.
Looking back to the late 90s, I feel like it's easy as a commentator to always be talking about how crazy markets are, how inefficient they are. Over the last 30 years, do you think markets getting more efficient, less efficient? What do you think?
I think it's a hard one to say like quantitatively. I'll just give you some thoughts is that the case for indexing has continued to get stronger when you look at percentage of active managers that have outperformed. So that would lend one to say that the markets have continued to be at least highly efficient. The second could be that you mentioned that chart of all the cash flows going into low-cost funds. There could be a case where the weak hands eventually get forced out of the market, right? So it's kind of like if you were at a tournament, a soccer tournament or a football tournament or a poker tournament, and you start off with 100 players, and now you're down to like 5 or 10 players. And so there could be a real case for all of the novices get flushed out through time. They can't compete. And you're now left with the 3 or 4 best soccer teams or the 3 or 4 best poker players at the table. So there's no indication that the market has become less efficient. Let's put it that way. And most indications are it's getting harder and harder to beat the market. That doesn't mean, I mentioned earlier, that we have close to $2 trillion in active management. When we look at the cohort, when you look at Spiva or Morningstar or anything, you see these charts of only 20 to 30% of active managers win. I think not many people take the next step is there any commonality to those 20 or 30% who keep winning? And they are. Vanguard's active funds have beaten not only their peer group, but we have beaten the friction-free benchmark. I would say that again, that's the friction-free benchmark. No friction at all, not even an expense ratio, no bid-ask spreads. We've been able to do that on the active taxable fixed income, the tax exempt, and the equity, because what we do is we hire world-class talent, and then we give them very low cost to the index. And so if we're only asking our active teams, both on the fixed income and equity side, to let's say pick up 10 to 30 basis points, we believe that there's that much alpha. You have to be different from the benchmark. You have to have talent and insight. And then if you only need to make up 10 to 30 basis points, active can win, and it has won at Vanguard. It's unlikely that you're going to be able to pick up 75, 80 to 100 basis points. And that's largely why the case for active does not work. It's not that there's not talent. It's just that the cost is greater than the talent.
They keep it all. They keep all the alpha. Arguably my favorite Bogle quote, which I don't feel like people have heard that much, and I'll probably get it somewhat wrong. But he has a quote where he says, the conflict in the industry is not active versus passive, it's cost, or something like that, right? So to me, the struggle in today, indexing kind of means something to me in my mind. But the pollution of kind of what you could do as an index today and what you can do as an active manager, the world has become so muddled. The true challenge is you got to read past the name of the fund. You got to read the prospectus or understand what it actually does and what are the actual costs. And I feel like in a world of short attention spans and just reading the headlines, not many investors do that. So just because it's, quote, index, you could charge 2% per year for an index. You could charge 5 bips for an active fund. So it's do your own due diligence, listeners.
It's so funny you say that. I had a presentation like 10 years ago, and I had on the title, Case for Indexing, and I had indexing crossed out. And my compliance and legal team were saying, what are you doing? You have the case for indexing crossed out. I said, there is no case for indexing. If an index charges 100 basis points, what is the case for it? It's really a case for low cost, high talent versus high cost. An 80 basis point index fund of the S&P 500, it's hard to make a case for that. So it really gets back down to talent can add some form of alpha, hopefully. And is that alpha greater than the costs that you're charging for that? Even indexing is not a commodity. It's how are you tracking? Are you tracking really tight to your benchmark? And what are the costs? Because you could have a low-cost index fund that has high tracking error or poor sampling, and you may not have good performance. So I think you're exactly right. The details matter, and the details are way more important than the labels or the words of just index and active.
We'll bounce around a little bit here, but you had a interesting line that I want to hear you expand on. It was with our buddy Barry Ritholtz in Masters in Business, where you said investors make bear markets for themselves. What does that mean?
Yeah, I think there's been way more bear markets caused by investors and their own behavior or reading the press. A great example, and I know I've heard some of your stuff and I follow a lot of your stuff, is just how long has everyone been anti-large cap growth stocks or anti-Mag 8 or Mag 7? And how much has that costed investors by being underweighted those stocks? Because yes, they are overvalued, they have high valuation, everyone is against them, and yet they have just continued to crush it. U.S. growth and large cap growth has crushed value repeatedly over year to date, 1, 3, 5. So I just think investors tend to, we're all good storytellers and we hear these stories and we hear that X is undervalued or overvalued, and we create our own bear markets. I think a lot of people, even just in this year, 2024, we're sitting here year to date, 2024, we're up close to 30% in the market. A lot of people just forget the equity market sold off 10% in July and August. You would have read the headlines as if this was the big one. Almost all the headlines were calling the end of this bull market. And here we are, just had a tremendous rally off of those August lows. So I just think investors with their own actions, and that's again why behavioral coaching I think is so important, because there's more bear markets created by investors and their own behavior than actual bear markets that occur.
You had a great quote. Again, we're going back to the archives, listeners. Rodney Dangerfield, he's sort of like the Dave Chappelle of our generation, maybe. You wrote, this is almost, 2015, almost 10 years ago. High quality bonds are the Rodney Dangerfield of investments. And so one, I wanted to walk forward because high quality bonds, for most of them, they don't have a lot of juice relative to kind of T-bills and what else is out there. But also I wanted to ask you, what's the Rodney Dangerfield today? What's not getting any respect?
That quote probably still could go for fixed income. Right now, you're sitting with fixed income for high quality fixed income with probably a pretty low risk of loss and the ability to get 4 to 6% and sometimes tax exempt if you're in the municipal bond space. I don't know where the equity market goes. I'm not good at predicting the markets, but if you listen to most people, they're talking like 5, 6, 7, 8 on the equity market. To be able to get 70 to 90% of the return of equities that you can get in fixed income with 10% of the risk, I think fixed income is a really good allocation for investors as we move forward. And as you pointed out in that chart earlier, the equities are at a higher end range than they have been because the equity markets have been so strong. And so we're encouraging our investors to rebalance, make sure that they're rebalancing. And if they are doing that, because the equity market has been so strong again this year, taking some money off the equity table, not out of speculation or that you believe it's a bubble, but just that you're rebalancing, and you would rebalance that into fixed income. And the good news is the fixed income yields today are 300 to 500 basis points higher than when I actually made that quote. So the return expected forward for bonds is much higher today than it was 10 years ago.
You have a lot of conversations with advisors, investors of all stripes. What's sort of the vibe? We mentioned in the intro to this chat, I'm wearing a hat focused on emerging markets, and that's kind of been an area, really anything foreign investing has lagged significantly U.S., particularly U.S. market cap weighted. So S&P just creamed everything the last 15 years, and by quite a bit. What's kind of the vibe when investors talk to you about investing in foreign?
I think most of the advisors we're talking with and most of the clients we're talking with are committed to rebalancing and committed to keeping the allocation. I would say if there's one potential change, maybe the base rate. You said your portfolio, just to keep it easy, was 50-50. We had tended to be 60% US, 40% non-US. And I think most of the clients we're talking to would say, well, I'm still committed to international, still committed to emerging market, but maybe at a lower level. I'm not going to bail out on it because I know as soon as I bail out on it, it's going to have a tremendous 10-year run. But maybe instead of it being 50-50 or 60-40, maybe it's 70-30 or 80-20. And to be honest, that's okay too, because when you look at the diversification and the portfolio in general, the majority of the pickup and the benefits is to make sure you have some. The utility of diversification happens a lot at the front end. And what I mean by that is having 100% US, the first 10% going 90-10 US to non is a lot steeper than going from 40 to 50%. It's kind of like the Markowitz, you add one stock, two stocks. After you get to the 101st stock, there's still diversification, but it's at a lower utility rate. So we would encourage investors to not give up on emerging markets, not give up on international. And if you have to take a lower weighting, try to make sure you're still committed at 20, 25, 30%. We would rather have a client reduce it from 40 to 30 than just totally bail. And so we try to meet investors and educate them and try to find a compromise that works, because the worst answer, I think, would be for them to bail entirely on international and or emerging markets.
Emerging markets are like even I feel like even less. But the good news, I tried to make a joke on Twitter yesterday. I don't think anybody got it, where it was showing US as a percentage of the world's market cap. And I said I look forward to it being 105% by 2030, and nobody really responded. So I don't think anyone got the foreign allocation can't really be negative, but we've seen weirder things. Who knows? Maybe somehow it could be. What are you thinking about as we wind down the year? It's always a good time to reflect, look out to the future. What's on your brain?
Yeah, I think most on our brain is a couple things. We are celebrating next year the 50th anniversary of Vanguard. So I think that's a pretty big deal. I think the Vanguard effect, which we talked about, I mentioned some numbers earlier of where expense ratios were 97 on the equity to 34 and 79 on fixed income to 32. That's saving investors. If expense ratios stayed the same over the last 25 years, investors would be paying $116 billion more in fees. And so I think the Vanguard effect celebrating the 50 years, I think, will be commemorated. It's also 25 years of Vanguard's Advisors Alpha, which really changed the value proposition of fee-based advice. So those two things are coinciding. And together, collectively, I think what's on our minds is just this. It is a bull market in equities and U.S. equities. We just talked about international. We are committed really strong to try to get investors to rebalance and stay the course. I try to tell everyone, stay the course, which was one of Jack Bogle's famous quotes, did not mean set it and forget it. It is an active strategy. Stay the course is active because the markets are moving. And so what that means is to stay the course, U.S. equities up so strong, you would be selling U.S. equities, as hard as that may be, and maybe even taking a capital gain if it's in a taxable account, but putting that into international, emerging, fixed income, just to maintain the risk of the portfolio. Because the last thing you want, I talked earlier about the time-weighted return and the dollar-weighted return, this behavioral drag. You don't want peak equity as equities are peaking. And I don't know when they will peak. This bull market could last another month, year, 10 years. But eventually we know that bear markets do happen. They tend to come out of nowhere. They tend to be fierce. And so preparing yourself, almost like you would prepare for any other kind of emergency or evacuation, make sure your portfolio is the right portfolio for the future, not the past. And so with that, a lot of rebalancing is probably in order out of U.S. equities and into traditional high-quality fixed income and non-U.S.
I think investors, the challenge is, I can't remember the exact phrase Bogle used in his video. I don't know if it was over-rebalancing, or people always assume they want to get in their head, well, if stocks are expensive, I should go from 60-40 to 100% fixed income. The lure, the temptation of the timing it completely and exactly was always there, but really the more thoughtful way to go about it, write it down ahead of time, but say, maybe 60-40 to 55-45 or 50-50, God forbid 40-60, but there's some ideas where I think it's thoughtful to work through ahead of time. And we try to talk to investors. Most don't have a written investing plan, but we say you got to be prepared for a world in which gold is at 5,000 or 500, where stocks go up a lot or not so much. Anyway, I think it's hard. And then if you don't have the plan, you kind of get involved in that sort of, what do I do now? Hit with news every day. And if we know anything about geopolitical news, it's always terrible.
And I think the challenge is the acronym TINA, which most people are familiar, there is no alternative. I think that did exist for up until the last year or two where equities were the only alternative. But now you have money markets, so you have very conservative money markets, cash plus instruments, and high quality fixed income in that 4 to 6% range. So there is actually no more TINA. There is an alternative, right? So rebalancing now, you're not rebalancing to a 0 expected return or a 1% expected return. You're rebalancing to an asset that does have a 4 to 6% expected return. So hopefully that makes it a little more palatable and a little more easy for investors to do. And that's what we're going to probably be trying our hardest to encourage clients, because this bull market has been so strong. Most clients have inertia. They hate paying taxes, and I don't blame them. We all hate paying taxes. So it is somewhat hard to get clients to rebalance. We're big on education and helping advisors do that. And so that's what probably will be most on our mind as we approach the end of the year.
As you look out in the horizon and then you look back to your career, what's something you kind of change your mind on? 30 years, I can think a lot. The 20-something-year-old me versus the me of today, working with advisors, working with the zillion investors you guys have. What's something that you have changed the brain on?
Yeah, I kind of grew up in the FAMA French deep value CFA community. I worked for 3 hardcore intrinsic value, breakup value. And I think the world has changed a little bit. We're in a more of an asset light economy where book value and intrinsic value, the companies who have led over the last 20 years have really deep and long J curves. And so this idea of what is a breakup value or value in general versus growth in general, I think it looks a lot different than it did under Graham Dodd, and how you would, try to buy a company below its book value or try to buy a company just on the P&L or the income statement. As we've learned from Amazon and all these other companies, there can be a 5, 10, 15, 20-year J curve where the economics all accrue 20 to 30 years down the road. And it looks like a terrible investment from a traditional valuation standpoint, but it turns out to be a miraculous investment long term. And so I think thinking about just simple rules of PE ratios or price to book ratios, it's kind of like what we talked about earlier. You have to go beyond just the words index and active. I think you have to go well beyond the words of value and growth. If you're really just saying I'm going to buy low PE stocks or high PE stocks, or the market's overvalued because the PE is here versus here, I think that's run its test of time.
What's been your most memorable investment you look back on your career?
It's probably going to be boring, and it's probably because my investing is boring, but it's going to be my first investment, and it didn't do anything miraculous. I went to Drexel University and we had a co-op program. And so I was working at a very young age, and they had an automatic investment program into the company. The company probably underperformed the S&P 500 over 20, 30 years, but it taught me the magic of compounding. It's more important of when you start and how much you start than what you actually buy. And so it's kind of like exercise or diet or any other discipline. If you can just get started and you invest and you do it on a regular basis, let compounding work, I think will be more beneficial to most investors than trying to figure out, is the market overvalued or undervalued, or should I buy company A or B or sector D or E?
What's been the most memorable memory, good, bad, in between at Vanguard? Was there a time in your career and experience that just sticks out as something that was particularly seared into your brain?
Yeah, I'll share one. I joined Vanguard in 97 from the outside, and I joined Vanguard to help start our advice. So up until that point, Vanguard was direct only. We did not have advice. And so I'm an outsider coming from the outside and had already been to business school and CFA and the whole 9 yards. At one head of the table, I'm in this long conference room, and at one head of the table is Jack Bogle, and the other head's Jack Brennan, his successor. And they said to me, so let me get this straight. You're going to charge 85 basis points for our life strategy funds. And that's what we were doing. We had a fee base for advice of 85 basis points on top of a market cap weighted portfolio that rebalanced, didn't do tactical, didn't do fire higher rotation. It was one of the toughest questions I had, and I kind of shrunk in my chair a little bit, but it actually helped me create this theme called Advisors Alpha, because we added the 85 basis points through eliminating tax leakage, asset location, tax efficient. So it was all the things that, yes, we could actually add 85 basis points to a already unbelievable portfolio with things that really didn't have to do with investment management, but had to do with financial planning, wealth planning, and tax planning. And so it was a really tough question. And I think it led to my relationship with both of them. And I just feel like the luckiest person in the investment business to be very close with both of those individuals. And they were very gracious to me and mentors to me. So that's probably the most memorable event.
Fran, this has been a blast. I think people know where to go to find Vanguard, but your writings in particular, what you're up to, is there a particular place to go, place to find you?
Yeah, so Vanguard.com, and then we have 3 different sites. I'm on the financial advisor site. So if you go Vanguard.com, financial advisors, it'll ask you personal, institutional, or financial advisors. All of our research is up there.
Fran, it's been a blast. Thanks so much for joining us today.
Thanks so much, Meb.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.